some further depreciation expectations. So, while clearly depreciation could help in the short run, from a longer term perspective, we think that this is not a best structural policy to cure the economy. So let's look at a little bit the Visegrad 4 perspective. In the Czech Republic and also Slovakia, it is a Czechoslovak phenomenon that we have a relatively low level of foreign indebtedness in households and also among companies. And here in the Czech Republic, there has been no strong consensus on euro, and the economy was relatively sound. Slovakia was very much lagging behind all the neighboring countries at the end of the 1990s. So via structural reforms and also political consensus on euro, we managed to boost our economy, and we were able to meet the criteria with a big portion of luck also. Hungary and Poland, these countries are a different cup of tea. Basically, they have still some kind of worse structural problems, much higher foreign indebtedness. And if you look at now, for example, at the Hungarian case, you would expect that with this recession, the interest rates would be quite low, and the monetary policy will try to decrease interest rate. But if you look at the interest rate, 9.5%, this is relatively high, and the government is not talking about how to decrease the VAT, how to decrease taxes to help the economy, but the government is considering even an increasing of the VAT. The problem is that with this so huge foreign indebtedness and so strong depreciation of the currency, you are in big troubles, and you have to persuade the markets that the budget deficit will be lowered in the future, and then you will be able to roll over your foreign debt. A situation is similar in Poland, and that is the reason why they are now talking about euro adoption in 2012. They have also a relatively higher level of foreign debt and the key interest rate at 4.25%. So once again, if you look at the currency situation, you can see how stable was the Slovak koruna compared to the other Visegrad 4 exchange rates in the near past, which is clearly a big benefit, a long-term benefit for investment decisions. So what to expect in Slovakia? The interesting thing is that now the policy of the ECB is relatively good for us. We can say that it is more expansionary for Slovakia than for Germany, because our inflation rate is somewhat higher than the German inflation rate, so the real interest rates are low, and our financial sector is not in big trouble like the business, like the financial sector, for example, in Germany. So the transmission mechanism of the monetary policy is somewhat better in our country. And if we look at this situation from a longer term perspective, capital will definitely, in this uncertain world, will look for safer destinations, and euro can help, but of course it is not a substitute for good business environment. On the other hand, these are the positive signs of euro. There are of course negative ones, which is this temporary loss of competitiveness. Paradoxically, of course, the crisis is very bad for all these countries. Paradoxically, the crisis eliminated some of the main risk factors connected with euro, like higher inflation, overheating of the economy, property market bubbles, and these are not relevant, at least in the current environment. So we are relatively happy that we've joined the euro at the best possible time. So what is my message? What is my message for all the other countries maybe trying to join the Eurozone at a later point in time? The clear message is that if if your monetary policy is too independent, means that you increase your interest rates too much, the public starts to have credits mainly in foreign currency, and in that case your indebtedness will be much higher in foreign currency, and your economy will be much more vulnerable. So basically the message is that euro is a big shield against market turbulence for those with less sound policies. So if you have less sound policies, euro is a very big asset in the short term. With euro, Hungary would have been in a much, much better position. Of course, also Poland. It is not so true to the Czech Republic. So with less sound policies, euro is a big help. The problem is that you cannot get to the eurozone with less sound policies because you have to meet the Maastricht criteria. And our second message is that do not enter the club with sound economic structure. Euro is not a substitute for them. So to sum up this short presentation, euro is not a goal. Euro is not a final goal that we adopted the euro, we are happy, we will go on vacation. Euro is a tool. It's a tool in our hands, and what really matters is our policy. With good policies, we can benefit a lot from euro. With bad policies, it is a burden for us. So we are happy with the euro, but our advice is that it is not really a substitute for good structural policies. So as I said, we are happy with euro. Some people are more happy than others, and my last slide illustrates one of the most happy people with euro. And the reason is that changing our korunas to euros, now we have much more coins in our pockets, and these coins have much higher nominal values than before in korunas. So this is my last slide.
Okay. Now is the time for the scariest part of the evening, or maybe ugly is a better description. All of you have this form on your chairs or when you came in. The same forms were here last year when you came in. You filled them out, and now is the time. The day of reckoning has arrived to see how you all did. And I will ask my colleague Peter Novotny to come up and explain what you all thought was going to happen in 2008.